Hi guys, so I finally got the time and opportunity to read this amazing book, Trading for a Living by Alexander Elder. I've always wanted to read it, especially since it's always been recommended by everyone. And I finally sat down and I've read this amazing book. And it has so many good gems, and I've just summarized all the major points. I think this is a comprehensive summary. If you decide to not read it, I think it's as comprehensive as I can get with these notes. And unless you want to get his strategy, you can get the strategy in the book. So you can read the book if you want the strategy, but if you just want the points, the main points from it, I've written down 12 points of what he thinks are the most important lessons we can all learn. So the most important lesson I got, he says, never move your stop loss in the opposite direction. And so this is a tendency I and probably many of us have, which is that like your stop loss is moving in the correct direction, and then all of a sudden price is going against you. So you're tempted to start. So if it's a buy, you're tempted to start moving it down, and if it's a sell, you're starting to start moving it up when it's going against you. And he just says once you set your stop loss, don't change it. Bad habits appearing in your trading. So he was like essentially saying that the bad habits you have in your private life tend to show up unintentionally in your trading life. So if you're a gambler, if you're someone with addictive nature, it's going to show up. So you should have some control in your private life so that it doesn't appear in your trading life. And so things like discipline, if you struggle with discipline already in your private life, you're going to struggle with it on the charts. And so he has some recommendations on how to curb negative behavior and self-destructive behavior like lack of discipline. I personally like the waking up in the morning and running and exercise and things like that. So yeah, and like reading. These are disciplines you have in your private life that, or like say not drinking alcohol for a year or something like that. So you have some form of discipline so that you build discipline and it appears in your charts. So he talks about like two-faced traders, which is like the way you act in your private life is very different to the way you act when you're being watched. So I've always liked this research. I forgot who did the research, where he researched traders who were performing while they were being watched and those who traded without being watched. And you realize that you'll have a really good trader, but once people are watching like through signals or copy signals or whatever it is, once he's under the pressure of being watched, his performance drops drastically, and it's just a psychological thing. I don't know why it is, but their performance drops. He says short-term gratification is a bad thing, and short-term big wins and gambles is like the major downfall for a lot of us, which is like wanting big wins within a short period of time instead of looking at the long-term goal of growing and consistently growing your account. And he talks a bit about curbing self-sabotage behavior through risk management. So if you, I like this routine this woman had in, I think it's Way of the Turtle. She would pray before she got onto the charts, and she would tell herself, "You're trading with God's money." Was it Come into my trading room? I forgot the book. And she would pray and say like, "This is God's money. Do not lose God's money." And that for her, once she hit 1%, she was off. That's it. She wasn't changing her stop losses or anything like that. And so it's just the way she decided to help discipline herself. Another method is to have like groups of people who you check up on each other, like, hey, are you risking 1%? And you just hold each other accountable until you build the discipline you need. He talks about the three pillars of successful trading, and those are self-explanatory. Psychology, right? Obviously, we know it's a psych game. Market analysis, which is your technical and fundamentals, and then most importantly, money management. And he says, think of it like a three-legged chair. It's a perfect chair until you remove one leg. If you remove one leg, you'll fall. If you remove one of these three, whichever one it is, you will fall. So there's no amount of good technical analysis can protect you from poor risk management, which is, I think, like one of the most crucial points he puts up, which is that most traders think that if you have a 95% win rate, a 100% win rate, that's going to help you with your poor risk management, and it always leads to the same thing, which is blown accounts. So, and I think there's always like been this selling wave and frenzy by people where they try to sell you a system which they say has such high win rates, and so you get lured into that because you think what you need is win rates, whereas what you need is all three. a good system, which is 30, which I believe is 35% to about 60% win rate. Anything other than that, a lot of the times you have a high win rate but poor consistency and returns. You tend up a poor risk management. So those three legs are really important. If you remove one, the chair will fall, and no amount of perfect analysis is going to save you from poor risk management. Trading strategies are like diets, and so he was like, they most of them work. Most trading strategies work if you use them. The only problem is that people don't stick with them for the long run. So strings of losses are inevitable, but you have to wait out those losses, and those losses are going to be counteracted by the wins. So most strategies work just like most diets work. It's just people start to twinkle with them and to change them and things like that, and they don't stay with them in the long run. Or what alternatively, what people do is that they'll stick with it for the first 5 months, and it's winning and it's working, and then the minute a loss is on the horizon, then they jump ship and they leave the strategy, which is why it's like, your strategy is like a diet. All you need is a positive expected return on investment. So, positive expectancy in your system, that's all you need. If your strategy has a positive expectancy, say of 35%, that's all you need. You don't need a 95% win rate. It's unnecessary, and a lot of the times it does lead to blown accounts. I don't know what the maths I don't know what the maths is around that, but it's just the way it is. That I've talked about that though. That somehow when you looked at the graph, it showed that like the winners were those within the 35% to 65% win rate. Past that, a lot of them had blown accounts. I don't know what it was about that. It's just the way it is. Um, we talked about no trading strategy can make up for poor money management. He says don't risk more than 2%, which is really important. And then if you want to get into his strategy, he talks about the triple screen trading strategy, which I think even if you don't use it, I think it's really important to go through, because he talks about having a top down. Sorry, there's this piece floating around. He talks about having a top down analysis from like weekly, daily, hourly, things like that, so that you're genuinely not trading against yourself or trading against the wave. So, whatever it is, whether you're looking for a counter trend in the smaller time frames or you're looking for a bigger move in the higher time frames, you can use the triple screen strategy he uses. And a big thing on indicators is that he says indicators work, but you must understand many of them. It will not help you if you understand one and you're like, I use RSI, I use MACD, or whatever it is, and you use it independently. You must understand a lot of them, because certain indicators work for certain systems and certain indicators work for certain economic events. So, depending on where we are on the charts, you should apply the correct indicator accordingly. And certain ones, like momentum ones, are suited for certain times in the markets, and then others are suitable for other times in the markets. So you should know which ones you should be using at which times, and you should know which ones are suited to your strategy. And it's also good to have many as confluence, because a lot of the times what one indicator will show you, another one will tell you something different. So if you only use two, you're always going to have things which are conflicting. Whereas if you have multiple, you'll have maybe three telling you one direction and one telling you the other. So you have a confluence, right, before you jump into a position. Strings of losses plus poor money management equals blown accounts. That's just it. Strings of losses aren't a bad thing, as he says, but it's just that if you have strings of losses and you have poor money management, that's when blown accounts happen. So if you have strings of losses but you're losing 1% at a time, you're not going to blow your account unless you lose 100 trades in a row, which is very unlikely, especially since all you need, if you took a regular person, they have a 50-50 chance of winning a trade. So essentially, you will most likely be in positive expectancy if you have a good strategy, even with strings of losses. So really, I think the most important of the three leg is the poor money management, even though he says like all three of the legs of the chair are really important. You have to control your emotions is another thing, and you have to be realistic. So he talks about like taking 100 or 1,000 to a million. That's not realistic. And a lot of the times, emotions will get into the way if you have that kind of mindset. And so his solution is to have a journal where you write what you're going through in your private life, which is also really important. Because if you're struggling with your finances in your private life, that's going to show up in your trading, because you're going to want to make up for it, and you're going to want to double, triple, and things like that. So it's important to have realistic goals in your journal and to talk about your emotions and what you're currently going through. Um, Long-term targets instead of short-term targets. So when you're writing your journal, you should have short-term and long-term targets, but not focus mainly on the short-term targets, but the long-term targets. Because when you focus on the short-term targets, you're going to be more emotional as opposed to the long-term targets. One indicator doesn't rule them all. So he doesn't recommend one indicator. Like I said, he recommends so many indicators that you should use and that you should apply, because, like I said, many indicators give you a confluence, and you shouldn't just rely on one. Um, and that also, when I talk about confluences, he was like, you should also set up rules before you enter into a position. So maybe you'll say, I need 3 indicators telling me this, or that before I enter into a position. And that's your confluence plus your fundamentals and your technicals. So that's what he means by setting up rules and confluences. Um, I found this point really important, which is like watch related markets. I cannot emphasize this point enough. And so things like gold and the US dollar, obviously, we all know that when one goes down, the other goes up. So they have a nearly perfect negative correlation. And so he says, like, watch related markets like that, so that when the US dollar is going down, you're prepared for gold going up, or silver, or the yen, right? Because the yen and the US dollar have a negative correlation. So he's like, you need to understand related markets. Um, Otherwise, you're going to be trading against yourself. I find that really important, because it was a weird thing I realized, where you'd like have 2 positions in, and then before I knew about like related markets, it was that you'd have 2 positions open, and you'll see the one going up, and then at the same time, while this one's going up, the other one is going into losses. And so you'll have one going up and then one going down into steep losses. And because you don't understand correlations or related markets, you're going to be essentially trading against yourself. And so at the end of the day, you end up with negative, because all your losses have chowed up all your wins. So it's important to know related markets. You need a bigger fishing rod to catch a bigger fish. Don't count your money, and practice sound money management. So when he says you need a bigger rod, fishing rod, to catch a bigger fish, he means if you need to make more, you need a bigger account. So you can't use a tiny fishing rod and say, I want to make millions with this tiny fishing rod. And so he says, if you want to see biggest growth, you need to have a bigger account, instead of trying to use this fishing rod to try catch a whale. I think that was really, really important, especially on the point of blown accounts, where he's like, you're not going to make a million with your $100 account. It's just going to lead to blown accounts. So increase the size of your account so you can catch higher returns and more money. Um, and he essentially says, listen, it's not that hard, and anyone can do it if they have a purpose, they're dedicated, and they practice sound money management. Um, on some other insignificant note, he also talked about like market crashes and things like that, multiple crashes and things like that. He essentially says just avoid things like that. Don't dive for volatility, and don't try go for volatility. It will end in tears. Is there anything else I left? Stop. Oh yes, where he says about like you're controlling your emotions. Like he said, set realistic targets, focus on long-term goals, have a diary, have a plan. So like your exit plan, your stop trading, your stop loss plan, and have a plan. And all in all, I think this is a really, really good book. Dr. Alexander Elder has done an outstanding job. It's really, really good. It's an easy read, simple strategy. Even his strategy, which is very rare. Doctors never give you their strategy. Whether you read Jim Simon's book or whoever's book, they will never actually share their strategy. whereas Dr. Alexander Elder actually shared his entire strategy, the indicators he used, his mentality, his psych. I would say it's an all in all comprehensive book. It's one of the few rare books where you have both technical, fundamental, and psychology in one book. Absolutely. I would give this a 10 out of 10 without a doubt.